In this video, we'll look at the Kinked demand curve. By the end of this video, you should have a better understanding of the Kinked demand curve. Before we look at the curve, let's first establish our assumptions. In the Kinked demand curve model, it is assumed that firms are non-collusive. This means they are not working together to fix output and prices. Second, there is price rigidity, which means there is a tendency for the market to settle at one price, above which firms will not follow an individual firm, should they choose to increase their price. However, below that same price, firms will respond by increasing their output. To better understand the Kinked demand curve, let's draw in two sets of demand curves for the individual firm. One in which the demand for the product is elastic, and the other for which the demand curve for the same product is inelastic, D1. I've also included the marginal revenue for both demand curves. Now let's assume there is a price P star at which this market has settled. The corresponding quantity is Q star. If we strip away the overlapping curves, we'll have our Kinked demand curve. Now remember, we're looking at the demand curve for an individual firm operating within the oligopoly market. This is how the Kinked demand curve should look. We keep the elastic demand curve above P star and keep the inelastic demand curve below P star. The logic of this will be explained momentarily. We also include our previous marginal revenue curves. The reason for the elastic demand curve above price P star is relatively simple. If a firm chooses to raise its price, the model assumes that other firms will not follow the price increase. Suppose firm A increases its price, firms B, C, and D assume that consumers will choose not to pay more for the product. Some consumers will no longer purchase from firm A and become customers of firms B, C, and D. However, if firm A decides to decrease price below P star, then the competing firms are worried about losing customers. In response, they quickly lower their prices too, which prevents firm A from gaining a larger portion of customers. When firm A drops their price below P star, it triggers a price war in which all firms start to lower their prices in order to compete for business. Once again, if firm A raises prices above P star, it runs the risk of losing market share at the gain of firms B, C, and D. On the other hand, if firm A tries to increase market share by dropping price below P star, firms B, C, and D will attempt to prevent that from happening by dropping their prices too. Now let's focus specifically on the kink. There's a discontinuity of the marginal revenue curve at Q star because there are demand curves and thus marginal revenue curves preceding and following that level of output. There are a rise in marginal costs. In this case, marginal costs could rise, but the profit maximizing level of output will remain the same. I've included two marginal cost curves, MC and MC1, to show you that there would be no change in output or price if costs were to rise. By now, you should be comfortable with drawing the Kinked demand curve and understanding its shape. If you have any questions or comments, leave them below or email me at EnhanceTuition@gmail.com. In the next video, we'll take a look at collusion and what it means for firms operating within an oligopolistic market structure. That's us done for now, and I will see you in the next one.